So today we're talking about how dividend investing is still relevant even though the stock market goes higher, higher, and higher. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour, Mike Leroux here. You're listening to the Dividend Guy podcast, and today we put my strategy to the test. Big podcast. I'm a bit nervous. I am with my co-host Vero. She prepared me mentally. She's going to attack me like right, left, and center. So it's going to be a pretty good episode today. So how are you doing, Vero? I hope that you're fired up, maybe to see some cracks in my strategy.
Well, hopefully my brain is doing better than my back because I hurt my back today with my horse. But, it's a good problem to have, right? Like I have a horse.
It's a good way to see it, actually.
Well, Mike, this episode actually was inspired by a DSR member, Peter. So hi, Peter, who asked you how dividend growth stocks perform during like various market periods, like bull market, bear market, volatile market, etc. And you wrote an entire newsletter for DSR members on the topic, but it can also definitely help listeners by providing them with a perspective on the dividend growth investing strategy and its mechanics. This is the end goal today.
I've seen a lot of question about comparing the strategy versus the market. And it's not the first time. Most of the time, what happens is when the market goes up super quick, as we are right now, kind of like breaking records almost every week, a lot of investors tend to look back over the past 5 years, look at what worked better than other strategies, and then they start having doubts. They're starting to say, well, if I had invested in the S&P 500, all my money, I would have been better off. And I mean, it's probably the case for a lot of investors. Totally agree. But there's more to that. And there's more to 5 years of investing as well, because you know that as well. We don't invest for 5 years. We invest for like 40, 50, maybe 60 years of our life. I mean, when you think about it, someone starting to invest in their 20s or 30s, they're going to invest until they pass away, hopefully in their 80s or 90s. So it's a very long period. And then 5 years doesn't mean much. Before we get there, I just want to share a story. When I started my career as a financial planner, it was in 2017. So in 2017, if you remember, not 2017, 2007, sorry.
Yes, I was like 2017, Mike.
I tried to get younger at one point. 2007, so a year before the financial crisis. So when we looked at the 5 years return, which is a classic for all portfolio models, everything was showing double digit. Even a conservative model was like high single digit, almost double digit returns over the past 5 years, because between 2002 and 2007, it was very easy to make money. And then ironically, you look at the same 5-year returns, but on January 2009, so like 18 months after I'm in this career, and now everything is like either at zero or negative. So it's like out of the blue. So just focusing on the past 5 years, depending on the timing you do it, will give you big differences. And this is why I wanted to go a little bit further in this analysis and go a little bit backwards and look at what happened in 2010, 2000, and even in the 90s for the US market.
So yes, before we get into the results, like walk us through your methodology that you use for this research. Like what ETFs did you pick and why? And what periods did you compare?
So to be fair, I needed to look at ETFs and not my own strategy or my own portfolio. I mean, first I started dividend growth investing in 2010. So I started investing in 2003, but between 2003 and 2010, I didn't have much of a strategy. Actually, I was just buying, selling, having fun, following the market. And then eventually I started to think, well, you know what? It's better to invest with a plan. And this is what happened in 2010. So I only have 15 years to show, and I didn't find it was really fair to do that. So I tried to went back as far as I can go. So for the US side, the benchmark is the Vanguard Dividend Growth Fund Investor, VDIGX. I didn't take it because it was the best performing, but rather because the history was since the 90s. So I had more periods to look at because I wanted to look at what happened during the financial crisis, what happened during after that, since inception, and of course, most recently. So the Vanguard Dividend Growth Fund Investor was a great candidate for that. It holds 45 companies. Right now, the top 24 includes a lot of companies that could be in a DSR type portfolio, such as Microsoft,
Right.
Apple, McDonald's, MasterCard, Visa, Texas Instrument, TGX, Honeywell, Nike, Accenture. Anyway, so you get a picture. So it's well diversified, a lot of like low yield, high growth stocks. So pretty much aligned. On the Canadian side, I was not as lucky in terms of history. So I had to went back and found the iShare S&P/TSX Canadian Dividend Aristocrat. So CDZ.TO. There's about, I don't know, like 10, 12 dividend paying ETFs. And I mean, this one is okay. Not exactly my favorite one either, but I still had to something that had a long history. But I mean, the top holdings right now includes such of the high yielders that are not necessarily performing, like Allied Properties, Telus, Southbow, Canadian Tire REIT that I like. You have, like, of course, some classics in the banks, like at TD Banks. You have Great West, Emera, Enbridge, Our Corporation. So a lot of like classic players, but probably not exactly as aligned with the DSR philosophy, but still I needed to start somewhere. So there you go. I use classic benchmark for the wide ETF. So SPY on the US market and XIU on the Canadian one. So ideally I would have selected my portfolio again, but that would have been a bit cheating because I already know the results. And that was one thing that I found it very interesting here is I've went with ETFs that had long history, not knowing what the results were. So I literally wrote that newsletter as I was going. So no knowledge of like the results. And then I didn't want to be biased, but rather look at the results and then try to explain them.
Okay, so like you said, you started this without knowing who would win, but like, what did you expect to find?
First, I want to say something. Before I write this newsletter, what I told my members on the first page is I don't care which strategies win. I don't care of beating the market either, because what is really important to me, and we're going to get there later on in the show, but is to reach my financial goals. And to do that, you need conviction. So if you can't invest with conviction, it's not really relevant to know if you can beat the market or not, because again, you're looking behind. So I mean, hindsight is always 2020. So there's not much merit to say, oh, this strategy won over the past 5 or even the past 15 years. I'm going to do that. Well, you have no clue if it's going to be the same thing in the next 15 years. In terms of expectation, though, I thought the DGI ETF would beat, like the dividend growth investing ETF would beat the Canadian market, mostly because the Canadian market is not that diversified, mostly focused on natural resources, oil and gas, and banks. So on the financial side, it did well no matter what is the period you look at, but for the rest it's a bit of like a hit and a miss from time to time. So I thought, well, if you just focus on quality companies increasing their dividend, probably it's going to be the Canadian market. On the other side, for the US one, well, pretty tough to beat the Magnificent Seven. I mean, it's literally, even to this date, over the past 5 years, only those 7 stocks drive the entire market. It's responsible for most of the returns. It is now more than a third of the index of the 500 companies. Only 7 has this huge weight. So obviously, if you don't have those in your portfolio, it's kind of like almost impossible to beat the market. And I remember when I was a financial planner, once again, we were comparing like different fund managers. And on a specific year, back in like the days that Apple crushed everything, if you add Apple in your portfolio, you beat the market. If you didn't have Apple in your portfolio, you just lagged the market. That was like one stock that moved the needle for
Crazy.
like hundreds of portfolio managers. Yeah, that was crazy. So it's like one single decision on that specific year that decided if you were a good manager or not, which, I mean, over 1 year, completely irrelevant. But for those
Mhm.
guys, I mean, this is how they make their paycheck. So they could lose their job for not picking Apple on that
Right.
on that year, actually.
And also, like, just a side note, you've compared US versus US and Canadian versus Canadian. Like, some investors can mix both markets, but this is not what we're talking about today. Like, we need to be consistent, right?
I mean, yeah, you cannot compare like apples to oranges. And I've seen you bring a very good point. I've seen so many investors say, "Oh, I'm going to look at your Canadian portfolio and then I'm going to compare that to VFV, which is not only tracking the S&P 500 but also is not edge against the currency, which played in the investor's favor if he's Canadian over the past 5 years." I mean, duh. You compare the Magnificent Seven to like Enbridge and TD Bank and Power Corporation. I mean, nothing against those great Canadian companies, but you cannot really compete against Google, Meta, and Tesla and Microsoft, right? It's not
Right.
really fair. It's really comparing a truck to a Porsche on a straight line. You already know who's going to win.
And listeners, just before we get into the results, we will share like results of a lot of graphs. So if you'd like to see those graphs, I will put the link in the show notes at thedividendguyblog.com/248 because we also did some articles around this topic. Okay, so Mike, let's start with the long view. Since inception, the S&P 500 has beaten the US CGI ETF. How would you explain this?
I mean, well, first we start in 1993. So we go through the tech bubble, we go through the financial crisis of 2008 up till today. Like, as of, I mean, the newsletter was written as of June of 2025. So pretty much not too long ago, right? The only moment that they went face to face was during the financial crisis of 2008. So for the entire time, the S&P 500 beat the DGI index. And then just because of the major financial crisis, they were almost at the same level in 2008, but then quickly recovered. And then we got the Magnificent Seven that pretty much drove the S&P 500 way above any dividend ETF. So since 93, clear winner. And what I did is I compared like two investment. I think it was like $100,000. One is like $2.4 million at the end. The other one is like 1.5, including the
Hmm.
reinvestment of the dividend. So clear winner for the S&P 500. Quite impressive. I mean, we're talking about like $1 million difference. Of course, over a long period of time. More volatile though, which kind of normal. I mean, the other one was a little bit more stable, but was not able to grab those new companies skyrocketing. And keep in mind, that's one thing, like if you have a company like Apple, they didn't start paying a dividend until I think it was like 2000, I don't know, like 12, 13, around this
Mhm.
era. So the first 20 years in this comparison, you still have Apple in your S&P 500 getting like
Right.
this huge rush, but absolutely no dividend, so cannot be considered on the other side. So that's usually what happens. You have companies starting paying a dividend when they become a little bit more mature and
Mhm.
when management sees less opportunity to invest their capital inside the business. And this is where they start paying a dividend. So, of course, it's usually a sign that, yes, they can continue to thrive, but it's probably going to slow down a little bit.
And the reason why it's less volatile too.
Yeah.
On the Canadian side, dividend growers have actually beaten the TSX since 2010. So why do you think DGI worked better in Canada than in the US over this period?
So for this one, it was a tight race, still starting with $100,000. In 2025, we are at 380 for the dividend investing index and then 344 for the TSX 60. So small difference, but throughout the entire period, the dividend stocks were always ahead. So they went very, very close during the pandemic, but still for the entire time, it was always a little bit better to invest in stocks. I'm not surprised because the dividend ETF is more diversified than the overall market. And as I mentioned, the major problem here is around natural resources. I mean, between 2010 and 2020, it was not a good period for natural resources in general and energy stocks. So that explains probably why the TSX 60 lagged behind the Aristocrat Index.
Now, let's talk about the last decade. The DGI ETF preserved capital while the market lost money. So first, like, what's the last decade? Because maybe not everyone knows.
Mhm.
And why does DGI outperform during bear markets like that?
Yeah, it's been a while. I mean, in 2000, I was starting university. That's kind of crazy. So
Right?
I did not even have a dollar invested back then. So I kind of like started in the middle of the lost decade, which was not that bad because the lost decade is between 2000 and 2010. The problem is right after 2000 starts, we have the tech bubble that bursts. Then we have the terrorist attack against the World Trade Center in 2001. And right after in 2008, we have another financial crisis. So,
Mhm.
two major market crashes in the same decade. So of course, if you have invested in the S&P 500 during that time, your $100,000 is worth $90,000 10 years later. So not a great year
Mhm.
for people. I'm just thinking like of people that started retiring like in 2000 or
Yes.
2001. That was definitely not a great timing. Fortunately, we already know that between 2010 and 2025, it was like great years, but that was a rough patch for investors. The dividend payers, though, the dividend growers were up $127,000. So beating by kind of like a wide margin here, which shows you that if you go for quality, a little bit more mature businesses in general, there is a good chance that you're going to do better when the market tumbles. Because that's the problem when you have the S&P 500, you have like great companies in there, but you also have potential losers that are struggling. And then when you're hit by a bear market, well, everything's going to go down, but you're going to suffer a little bit more losses with those weaker companies than you can find in a dividend growth investing portfolio.
And between the 2008 financial crisis and 2020, both US and Canadian DGI ETFs outperformed the index. What's the message here for investors?
Well, the thing is, now, of course, I cherry picked in a sense where I started right before a crisis. So in January of 2008. And then we stopped right before the next one in 2020. So
Right.
just wanted to see what's the impact if you're about to retire. And this is like a major concern for most retirees. You're seeing that day that you're going to stop adding capital to your portfolio and having to shift your mindset to withdraw money from your portfolio. And then you're thinking, well, what if this year, my retirement year, is the year of market crash? And that could hurt. We have seen like all those graphs where it could hurt deeply your portfolio and therefore change completely the rest of your retirement budget for the next 30 years. A good solution to protect against that is not necessarily just to focus on getting the dividend. So a lot of investors are thinking, oh, I'm going to avoid withdrawing, like selling shares by just living off dividends. So I'm going to focus on higher yielders, which
Hmm.
comes with other types of problems and risk. But if you just have a cash wedge, as we have explained a few times on the show, well, during a bad year, and if today is your year of retirement and today is the year of a market crash, you just withdraw money from the cash wedge so you don't have to worry about where your portfolio is. Obviously, if you focused on quality companies, though, your portfolio will take a smaller hit and then we'll still continue to benefit from the market going up. When we're in a bull market, the high tides rise everything. So it's kind of normal. So the quality will always do a little bit better. And you can see clearly in the graph that during the drop, what we see that the dividend payers will drop less. So all the studies telling you that the dividend grower and initiators tend to outperform the market and do it with less volatility. That is definitely true when you look at those volatile periods.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you.
Okay, so since 2020, it was time for the market to shine, especially the S&P 500 with the Magnificent Seven, like you've mentioned previously. But were you surprised by how the DGI ETFs lagged?
Not at all, because on top of the Magnificent Seven, the rise of AI, we also saw a lot of new retail investors coming into the market, flooding the market. And I mean, it seems a while ago now, but the 2021 meme stocks, I mean, the GameStop, AMC, even BlackBerry made a comeback on that year. That
Right.
was like kind of
Right.
crazy. It was all about finding those funky stocks, and then a bunch of retail investors with just pouring money into it so it rises like there's no tomorrow. So we had a lot of hype, a lot of like bubble going up and bursting as well, like small bubbles. I remember as well in 2021 there was those SPAC account, those companies, like those are like empty companies that are listed on the public market, and it's kind of like an easy way for a company, instead of like going through the entire process of an IPO, they merge with those specialty companies that are just like empty shells waiting for someone to get in, actually for a company to get in. And then it was the big craze. And then people started to buy those SPACs like there's no tomorrow, like it was like the thing that is going to double, triple, quadruple your portfolio. A lot of them died, unfortunately, as it
Yeah.
is the case when you go into that kind of like super hype product that is going to
Right.
revolutionize the investment. I mean, unfortunately, it's pretty rare that it will revolutionize the investment world, and that was not the case. So those boring Procter and Gamble's type of stocks that are always stable and generating consistent cash flow but not exciting anyone, well, they did what they have to do. They actually help a lot of investors reaching their financial goals, but definitely lag behind those super sexy high performer companies.
All right, so across all four periods, you highlighted three key takeaways. So DGI outperforms in down markets and when it's less volatile, but indexing usually wins in the long term. So here comes the big question that you've been waiting since the beginning of the episode. Why choose dividend growth investing then?
Yeah, I mean, the academic studies and even my own studies are against myself here. So, why in the
Right.
world would I spend so much time and energy to focus on selecting stocks where I could literally just do XCQT and chill, right? Totally fair
Hmm.
question. And to be fair, index investing works super well, but dividend growth investing works as well. And here's the thing. First, as I mentioned as an introduction, reaching my financial goals are a lot more important than beating the market. That is like number one. But in order to reach my goals, I need to be able to invest with consistency, right? To always follow the same strategy. And to be able to follow the same strategy, I need conviction, because there's no way I can continue to invest in any type of investment strategy if I doubt myself, if I look back, if I hesitate. I need something where I can invest with confidence.
Hmm.
And to do that, I need to know what I own. Because if I invest in an index, oh, yes, I have like 500 companies. Or if I take that example of XCQT and Chill, XCQT has like between 8,000 and 9,000 securities in their portfolio. All right, so I own literally everything in the world, but I don't know what's going on. And if it goes down, I cannot explain it because so many different things are happening at the same time. So I don't know what I own. And that is like a very important point if I want to invest with conviction. And the second point is I need control. I want to control my portfolio. You know, there are a lot of people when they have a bad luck, there are like two types of people. A lot of people will say, oh, it's because of this and because of that. It's like external causes. Like I'm not lucky, whatever happens, the world's against me anyway. And there's the other type of person where they say, it's all because of me. Like all my success is because of me and all the failures is also because of me. I am responsible for my action. And yes, sometimes you run into some luck or bad lucks, but most of the time you create that anyway. So those are like two beliefs. I'm obviously part of like the second one, where I believe that if I have the control over something, I can do greater things. So for investing into stocks, it gives me that control. It gives me that conviction because I understand and I know the companies and the business model I have in my portfolio. And good example was in 2020 when the market crashed during the first lockdowns. Well, I look at my portfolio and I did like one company after the other, determining if a lockdown would be a catastrophe or not for them. And I ended up maybe out of like 30 stocks, yeah, 4 or 5 were at greater risks. But I mean, are we going to shut down power? Of course not. So companies like Fortis are going to continue to do well. Are we going to stop using our computer if we are locked down? I mean, quite the opposite. So companies like Microsoft and Apple are actually going to thrive. And that was at the very beginning of 2020. That's what I told my members. Like, if there's one area that's going to thrive in the next 5 years is the technology sector, just based on that. And then AI was not even part of the portrait, but just to show you how you can analyze your stock one by one, and then you can see where some of them will thrive, some of them will do all right, some of them will struggle, and probably a few of them will die. Like a company like Disney definitely was a bad investment back then. So it's just you know then what to do with your portfolio and what's at risk. With the S&P 500, I have no clue, man. I mean, I'm not going to go through 500 companies. That's way too much. So it's impossible for me. So that's why I still, to this date, focus on dividend growth investing. And ironically, I'm still beating the market in terms of like my benchmark is 50% the US market and 50% the Canadian market because my portfolio is diversified 50-50 as well. And since 2017, I report my pension plan, which I cannot add capital. So that was like money that was invested 8 years ago. And to this date, I still beat the market, even with the Magnificent Seven against me. To be fair, I do have a good share of Apple and Microsoft in my portfolio, so that helps. But still, I mean, no Meta, no Google, no Tesla, a little bit of Amazon in their portfolio, so not even in the one that I'm comparing. So a lot of companies that are not there. I wish I had Broadcom. I said, I say it often. But anyways, I was still able to do very well even then. And with a good system, like I use Dividend Stocks Rock, of course, to manage my portfolio, I don't have to spend that much time to manage my portfolios. I spend like a couple of hours per quarter, and that's about it. I just read my pro report, I look at the quarterly earnings, and then I move on. So it's not that much work, not that much time, and actually have a better control and better understanding of where I'm going. That's why I continue to go with dividend growth investing.
All right. But no, there's no but. But in the newsletter, you've mentioned that even with some losers in your portfolio, like BF Corporation and Algonquin, and yes, like I know it still hurts, but even then, the DGI strategy still delivered for you. So what makes it resilient even when you make mistakes?
And I'm glad you bring this point because when you invest in your portfolio, you select like 20, 30, 40 stocks, whatever. You're going to have losers. You're going to make mistakes. It's impossible to have like 40 amazing companies that are all thriving, all beating the market. This is not how it works. But I see my portfolio like a hockey team. You know, I cannot expect Cole Caulfield to score a hat trick every single game. That's not going to happen. And sometimes he's going to go for like 4, 5, 6 games without scoring. So I need other guys to do that, the job. And this is where the teamwork is important. So yes, I'm going to have failures like Patrick Laine in my portfolio, but other players are going to do better. So this is where diversification is key and not investing all my money into like a couple of stocks that are focused on a single sector. Rather, I have like 9 or 10 sectors in my portfolio, and I have specific investment rules to make sure that my top lines are getting some support with some other players that, yes, sometimes they just play 10 minutes in the game, but still they will make the difference. So that's why having those companies like Algonquin that failed many investors. I mean, that was a big mistake. I learned from it. That's great. But at least it was 1 out of 30, 35 stocks. So I had other great companies to compensate.
So you've said like 2 or 3 questions ago, I'm not chasing returns, I'm chasing financial goals. But could you explain that mindset a little bit further?
Well, at the end of the day, what's really important? Is it to live stress-free and enjoy your life and enjoy your retirement? Or is it to die with an extra $250K or $500,000? I mean, now the $250K sounds great, but it's only because you look backward. It's only because you have that time machine that you can go back and say, oh, I could produce a lot more using this strategy. But how is it going to convince you to move forward? I mean, it's easy to play Monday morning quarterback, but it's not going to help your conviction in your portfolio. And it's certainly not going to help you if you switch your strategy today and then the bear market starts in 2 weeks from now. Because then you're going to, oh, I knew it. I'm that type of person that whenever I buy something, it goes down right away. I mean, come on, guys. Like, the universe is not against you. It's just like a matter of timing. One day or another, we're going to have a correction. But if you're not in control of your portfolio, well, then it's going to be harder. You know, I get often asked this question about like, okay, so what if you would not invest in stocks? What would you do? And I'm like, I would literally buy an all-in-one ETF that looks like XCQT. And then they're like, oh, but would you offer us like an idea of like the portfolio of ETF or an example of that? That would be very helpful. I'm like, I would have one line in my statement that would be an all-in-one ETF, and I would never watch the news. I would just have that in my portfolio, and that's it. That would make my life super simple, but that would be investing with conviction in diversification in a broad market where you have absolutely no control. If you cannot accept that, well, you're into reading a lot of stuff, getting sick, getting worried, and probably losing that conviction at one point.
That's the thing here. There's nothing wrong with going execute and chill or like such kind of ETFs. But the thing is, many people just don't do that. And this is where it creates doubts and confusion. So anyway, what's the biggest misunderstanding investors have about dividend growth investing versus index investing?
Well, again, it's really looking back 5 years and thinking what was the best strategy. And just for fun, if you really wanted to invest in the right place in 2020, it was not investing in the S&P 500. And it was not even Bitcoin, actually. It's quite close, but you would have still made more money investing in GameStop, which is kind of ironic a little bit. So depending on the date, maybe Bitcoin will beat GameStop. Actually, I'm pretty sure that it will, because it's been a while that GameStop hasn't done anything. But just to show you how it's crazy when you look back and say, oh, that was the right thing. And again, a lot of investors will take the S&P 500 as the ultimate reference, and they're not completely wrong. I mean, if you look at the past 30, 40, 50, 60 years, investing in the S&P 500 was probably the best choice any investors would make. So there is a good chance that it's going to repeat itself going forward. However, it's going to come with a lot more volatility. So you have to be able to stomach that for sure, for one. And for second, I remember my days as a financial planner, and ironically, not many investors were chanting the great S&P 500 in 2009 and 2010. They were just like still hurt from the lost decade, and they were not that sure that it's going to be the best place to invest. So just think about that. Now it makes it very obvious. Back then, I ran into a lot of people when I told them that they needed to invest in the US market to be well diversified. They told me, no, I'm going to go all in Canadian. The Canadian stock market did a lot better in the financial crisis. That's the best thing. Well, they did exactly the same mistakes as some people are doing right now.
Right.
They look back at the past 5 years and they selected what performed best. If you do that, you never know what's going to come up, and you might as well just buy GameStop. I don't know.
And they would probably like look at you like you were in your 20s. They would probably look at you and say like, you don't know anything. Like, I've been through like bad times and you don't know about, right?
Yeah. Fortunately, I didn't have any hair back then. Still, I was bald even at the age of 27. So that helped me a lot to get some credibility. But I got that a lot. Like, son, my youngest daughter is like older than you. Why should I listen to you? And I'm like, yeah, okay, fair point. I'm younger. I mean, what does it matter when it comes down to investing? But yeah, I got that a lot at the beginning. That was fun.
So, Mike, if someone listening is hesitating between indexing and DGI, like, what's the most important factor in choosing a strategy?
The most important factors are time, knowledge, and interest. The point is, if you have no time, it's going to be very hard to monitor your portfolio. If you have no knowledge, it's going to be very hard to read quarterly earnings. And if you have no interest, well, I mean, you get it. You will not even find the time or get the knowledge anyway. So if you're completely clueless, but you still know that you have to invest, probably that going for ETF is a lot better. And actually, I'm going to go one more notch. Probably that going with a financial advisor, even if he's selling you like ETFs funds or anything that is a little bit more expensive, at least you're going to learn. So that would be like the first step to learn a little bit more, and then you can grow. If you have the interest, you don't need time and knowledge, because once you're interested by something, you want to read, you want to learn, and therefore service like Dividend Stocks Rock, for example, will provide you the knowledge, will help you save time, and then you'll be able to manage your portfolio. We have helped several investors that started with basic knowledge, not too sure how this whole thing works, but they were sure of one, like yourself, but they were sure like of one thing. They did not trust their previous financial advisor. They wanted to take control. And by taking control, they had to select stocks. So having support from the platform, from the webinars that we do, answering all those questions live, from the newsletter, they found the support they needed to start their portfolio and learn and start this journey. But some people, they don't like that. And that's totally fine, because now ETFs are super cheap. They're well diversified. They're easy to buy. So that makes it the perfect candidate for a lot of people that has absolutely no interest in investing. The key point here is when you buy an ETF, you buy and you forget. You don't even watch the news. I mean, you can't control anything. So it would be like, you never go outside, but you keep track of the weather network, like looking at every single city in your province, in your state, in your country to see what the weather is going to look like in 10 days, but you're not going to go outside. I mean, what's the point? So shut that down. No more Seeking Alpha, no more BNN, no more the dividend guy. You buy your ETF and then off you go. You don't have to check about anything anymore. Once a year, you can do like a quick overview. But I mean, if you did your homework at first, there's nothing else to do. But I know it's really hard. So if you are going to look for news and read articles and watch videos, you might as well take full control of your portfolio and start with a strategy that you understand. That is super important, and that you have a high level of conviction.
All right, so dividendstocksrock.com if you're interested in knowing more of what we do. This was such an interesting discussion, Mike. Thank you. Like every time we do like those type of episodes, I'm always like ending the episode with full of confidence. And listeners, this is what matters. It's not outperforming the market, but investing with conviction. And actually, we can help you do that by choosing among the best dividend growers using our Dividend Rockstar list that you can download for free at thedividendguyblog.com/rockstar. For our show notes and related content, including like the articles with all the graphs that we've discussed today, visit thedividendguyblog.com/248. And if you like what we do, thank us by hitting the subscribe button underneath our podcast logo. You may as well leave us a 5-star rating while you're there. Until next week, stay invested.
Stay invested. Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.